Shares represent equity ownership in a company or financial asset. Trading in shares provide access to the stock market of some of the largest and most popular companies, such as Google, Amazon, and Apple. You can invest in shares online with CFDs and gain full exposure with a small initial deposit. CFDs allow you to speculate on price movements without physically owning an underlying asset, and you can trade both rising and falling markets. With the growing popularity of CFDs, an increasing number of traders prefer trading shares through CFDs instead of via traditional shares. This is due to advantages offered by CFDs, such as leverage and the ability to go long and or short. In addition, fractional trading makes it easier to diversify your portfolio while investing in multiple companies for a fraction of the share. With share CFDs, you can boost your buying power by trading with leverage. CFDs are leverage products, which means you can control a large contract value with a small deposit. Known as margin, essentially you only need to deposit a small portion of the total trade value to gain full exposure to the markets. CFDs provide potential to profit in both rising and falling markets. Basically, traders who trade CFDs are speculating on price movement by taking short or long positions to profit on the asset's price going down or up, respectively. You don't actually buy or take physical possession of the shares, and you can still make a profit when the price of the share falls in value, not just when it rises. Share CFDs allow you to invest in shares from several markets around the world, as well as in other instruments. This is known as diversification.
Hello everyone, my name is Emily and today we're going to talk about money management. In this video you will learn what money management is and how to apply it. In its broader sense, money management is a tactic traders follow to preserve their funds. This way they limit the risk of their portfolio while potentially maximizing its returns. In any case, money management is the aspect of your trading that greatly influences your profits. So it is an important part of a successful trade. In fact, according to studies, almost 90% of the divergence in a trader's performance is because of money management. Although it's not complicated, it requires discipline. Interestingly, irrespective of having a solid trading plan in place, without money management, you could still lose money. However, with a good money management system, you could improve your plan's performance and potentially have great returns as well. The basic elements of money management are the following: a stop-loss order for each trade, a certain amount of funds to risk in each trade, and the maximum amount to risk in a certain period. So the question is, what amount of risk should you take? According to experienced traders, you should never risk more than 1 to 3% of your equity in total in a trade. More aggressive risk could take your account as high as 20%, but there will be larger swings, and this could affect your judgment. It is true that every trader sees risk in a different way. However, the time you have to put in your investments, availability of capital for present or future movements, personality, and risk tolerance are some factors affecting how you see risk. What is important is to keep your risk small and constant, and remember that one trade should not matter. Thank you for watching.
everyone can see my screen. It should say IronFX Solid Trading Webinar Series. Thanks, Kurt. Hey, Nino. Hey, Ellen. Hi. Okay, I see more and more people joining. Hey, Lola. Hi. Everyone, I remember taking you guys recently, and I think a lot of you are from Philippines, right? If I'm not mistaken. Is that right? Okay. Oh, from the UK. Hey, Ola. Hey, Kurt from England. Oh, no Filipinos today? Shaq from UAE. Lola from the UK. Ola from the UK. Lola from the UK. Okay, so it's mostly Europe, I'm guessing, UK. And we've got UAE. Ismail from South Africa. Hello, welcome. Okay, we've got an international crowd today. This is great. This makes me very happy. And Kingsley from Philippines. Sorry, not Kingsley's from Nigeria. It's Karim from Philippines. Okay, we've got a worldwide crowd. Okay, hey everyone, I am going to start. Hey Nino, I'm going to start the webinar now so that we can spend a little, hopefully we'll find a little bit more time to be able to go to the live charts so that I can teach you guys how to apply what we learn, if we have time, okay? More importantly, we should go through the basics first. Okay, so welcome everyone once again to our webinar today. We will be doing advanced moving average strategies. We're going to go through advanced moving average. You guys already know moving average. This is the most simple form of technical analysis. I personally, when I just started trading, this is the first indicator I've ever learned, and you guys will be surprised. I paid quite a bit to learn this because I signed up for one of those crazy trading courses. Nowadays, things are free. Like you guys join this webinar for free, right? Yes, so back then I had to pay like thousands to learn the moving average. I know how ridiculous that sounds. Okay, let's do the disclaimer first. So just a warning, a reminder that whatever I share in this webinar should not be construed as trading advice. It should only be taken as educational. Okay, this is only an educational webinar. The whole point of this webinars by IronFX is to help you guys grow as traders. Okay, it is to help you guys grow as traders. Right, please don't take it. There's no signals, there's no forecasting here, okay? If you guys are waiting for the entry, the take profit, the stop loss, you're not gonna find it in this webinar because we can advise you when we think it's a good entry, but ultimately it's your choice. Another reminder, trading forex and CFDs carries significant risk and may not be suitable for all investors, right? So do be cautious, especially if you are new here. The risk multiplies immediately, especially if you are going on leverage or margin, right? So please do be cautious. For those who are new here, do not jump into the ocean without first learning to swim. Okay. For those who don't already know me, I think I've taken you guys once or twice before, right? For those who don't already know me, my name is Cass. I am an investment analyst and a prop trader here at Everest Fortune Group. So Everest Fortune Group, we're an award-winning research firm based in Singapore. We're a fintech company, okay? What we do, we heavily research on strategies, back testing, and we advise the banks, brokerages, financial institutions, hedge funds on where we think the markets are going. So we do a lot of research on the characteristics of the market, where it's going, how it reacts, and blah, blah, and we try to find strategies to overcome that. And like today, we are going to share the strategy that you can use with moving average. Okay, so Everest Fortune Group, we've won, we're the finalists for the best forex and best equity research for 2019, 2020, and 2021. Back to me, sorry. I personally am managing quite a actually it's way more than 300,000 now. Okay, I'm managing quite a bit of funds, way more than 300,000 US dollars on my own personal account. That's me as a trader. I've passed FTMO twice, and I've passed my forex funds twice. So for those who don't know what these are basically prop trading tests that requires you to have a 10% profit within the month. Okay, so I've done that consistently month after month, and hopefully as I go with you in this webinars, I can show you guys how I managed to do that 10% every month. Okay, cool, everyone, cool for now. Okay, I'm gonna move on. Okay, so our agenda for today will be to understand what moving averages are. Okay, and then we're gonna look at some of the common moving averages out there. We're gonna look at two today, and we're gonna look at the natural moving average. So natural moving average is a kind of strategy moving average that we use here as average fortune group. If you Google natural moving average, you won't be able to find a lot of information on it, because why? I think it's kind of a bit like it's something that we invented in a way, the natural moving average. Right, so this is because I was saying we spent a lot of time back testing and looking out for strategies and patterns on the chart. So we found that the natural moving average is a strategy that works very well on when it comes to trading. Okay, so just bear with me. We will get to the natural moving average towards the end of the sites or midway of the sites. And lastly, we'll be identifying reversals with the natural moving average. And if we have enough time, right? If we have enough time, we will be moving to trading view so that I can show you guys ultimately live examples of how this will work. Why? Because look, I love doing this webinars for you guys, right? It's a lot of theoretical stuff. It's a lot of textbook stuff, you know what I mean? So I can tell you what the moving average, the definition of the moving average. I can tell you the calculation of the moving average, blah, blah, blah. I can tell you so much about the moving average, but ultimately, if you don't know how to apply the moving average, it would still not be useful. You know what I mean? If I give you a pen and you don't even know how to do what to do with the pen, you don't even know how to write, that pen will just be obsolete to you, right? So ultimately, we will try to go to TradingView if we have time to kind of apply the moving average and see how it works. Okay, so before I move on, can you guys just let me know in the chat box if any of you use the moving average to trade? Have you ever heard of it, at least, the moving average? No, no one? Okay, thank you, Lola. No one has ever heard of moving average. It's the most, I try but don't understand. Okay. Yes, we got a lot of yeses. Yes, this is not unusual because, again, I said it's one of the most common indicators. I only look at it at a very basic level. Yes, me, myself, personally, I only use moving average on a very basic level, and I'll show you guys why later on towards the end of the webinar. Okay, so moving average, when I just started using it, I learned it very simple. Okay, if price, let me grab my pen so I can show you. So when I went for these crazy courses where I had to pay so much money to attend, the guy basically taught me that when price crosses above the moving average, you should get in for a buy. Okay, when the price goes below the moving average, you should get in for a sell. Okay, that's what I learned about the moving average. It works sometimes, doesn't work sometimes. Most of the time, it doesn't work that well. Okay, that's why you should never use, although today's topic is moving average, I must say, because like every week we'll go through different topics, right? Sometimes we'll go through moving average, Ichimoku, trend lines, support resistance, whatever it is. You should never use one technical indicator on its own to look for entry, stop loss, and take profit. It should never be only one to look for your analysis. It should always be a combination of all things to look for your analysis. And I want to use this example, which I am sure you guys heard when I took you the last time. It's the same as like you're going to a mall, you're buying a pink dress, okay? You see the pink dress, you don't know if it's good or not. So if enough people tell you that the pink dress is nice, you are going to buy it, right? But if everyone keeps telling you it's a no, you're not going to buy it. So it's the same it's the same as like you going to your dad, hey, does this dress look nice on you? And then your dad goes like, yes, it does look nice on you. And your mom says, yes, it looks nice. Your sister says, yes, it looks nice. And your brother says, no, it doesn't look nice. Okay. So similarly, when we're looking for trades and setups, we need different technical analysis to give us data and, well, not opinions, but more like analysis, right, of where those technical analysis think price is going. So if enough technical analysis is telling you that price is going up, you are going to get in for a buy. If enough technical analysis is telling you price is going down, you are going to get in for a sell. Okay, right? So moving average is just a tiny part of your entire analysis. Okay, it is maybe your dad. When you ask your dad, hey, is this dress nice? Moving average will tell you yes or no, it's nice or not. That means moving average will tell you it's a buy or if it's a sell. Okay, support resistance will be your mom. Okay, trend lines will be your brother. Okay, and so on and so forth. Okay, so again, moving average is just a tiny part. So let me explain what moving average is in a very textbook definition, right? Again, I'll go through all the textbook stuff, all the theoretical stuff with you, but ultimately you need to be able to grasp. Hey, Fauzan, welcome to the webinar. You need to be able to grasp how to use this indicator, the best way to use this indicator. You can know this in and out, but if you don't know how to apply it, there's no use. Okay, so let's go through the textbook definitions and all a little basic backstory on the moving average, and then we will try to go into applying. Okay, so a moving average is a technical indicator that market analysts and investors may use to determine the direction of a trend. Okay, it sums up the data points of a financial security over a specific time period and divides the total by the number of data points to arrive at an average. Okay, it is called a moving average because it's a continually recalculating based on the latest price data. Okay, to put that in the most simple terms that I can think of, right? That is the most textbook definition you can think of. Let's say you see all these candlesticks, okay? If you put your moving average settings to 5, it's basically taking the price of the last 5 candles and dividing it by 5. So it's basically the average of the 5 last candles. If you put the settings at 20, it's the average of the last 20 candles. If you put it at 100, it's basically the average of the last 100 candles. That's why you can see most of the time the moving average is there a best moving average? You know, when it comes to technical analysis, I don't think there's ever a best of anything. It's whatever works the best on whichever time frame and whichever charts you are looking at. So I'll give you an example. There are certain pairs, there are certain forex pairs on certain time frames works well on a strategy that we have found here at Evers Fortune Group. It's called the Nike Tick strategy. That's a totally different webinar. Okay, we found that that strategy works very well on gold. Okay, but that same strategy does not work very well on AUD USD, for example. Okay, so there's never a best of something. There's always which works best at that particular time frame and that particular pair and that particular instrument. Okay, that's why backtesting and research. I have to say, I don't think trading is hard. I think it's a very simple thing. You can probably teach it to a 12-year-old and they will be able to get trading. Like, what's so hard? You just buy and you sell, you put a stop loss and you take profit, right? It's not hard. The hard part is the time consuming part is actually backtesting and learning how to trade. That is the time consuming and the hard part, to be able to grasp and be able to collect all this data. Okay, so that I think is the harder part when it comes to trading. Okay, I hope that answers your question. So okay, let me continue with the definition of moving average. So analysts use the moving average to examine support and resistance by evaluating the movement of an asset's price. A moving average reflects the previous price action movement of a security. Analysts and investors then use the information to determine the potential direction of the asset price. It is known as a lagging indicator. Yes, moving average is a lagging indicator because it trails the price action of the underlying assets to produce a signal and show the direction of a given trend. okay, I'll tell you guys, when I started using the moving average, I was not making a lot of money. This was when I just started trading. Okay, why? Because the moving average is a lagging indicator. It gives you information that is slow. Okay, so in the beginning, when I was losing a lot of money in trading, I was thinking to myself, this indicator is so dumb. Why is anyone even using this indicator? You're only right like 4 times out of 10 times, or 3 times out of 10 times, whatever it is. And the times that you are right, you don't even make that much. When you lose a lot, okay, whatever it is. I was blaming the indicator. So now that I've learned as I grow as a trader, it's not that the moving average is completely useless. It's just like, maybe right now I find that I really love the Ichimoku cloud indicator, right? So to me, the Ichimoku cloud indicator is a Ferrari, and the moving average may be like a maybe a mom van, for example, maybe a van. Okay, so if you were to race, obviously the Ferrari is going to win, right? But it doesn't mean the van is completely useless. The van is still going to get you from point A to point B. It's just that the van is going to get you from point A to point B. It's more fuel efficient, maybe. It gives you more room. You can fit more people in the van compared to the Ferrari. So every indicator has its pros and cons, okay? So the moving average as well has its pros and cons, even though it is a lagging indicator, and we will look into that. Okay, so a moving average is a technical indicator that investors and traders use to determine the trend direction of securities. It is calculated by adding up all the data points during a specific period and dividing the sum by the number of times periods. The average moving averages help technical traders to generate trading signals. Okay, again, the general thumb of rule is if price breaks above the moving average, you are bullish. If price breaks below the moving average, you are bearish. But in this case, you can see how it didn't work out here. It wouldn't have worked out here because price was moving sideways. Okay, so that is the definition. The common moving averages out there. Today we are going to look at 3 kinds of moving average. One is, oh sorry, I don't know why I put the weightage moving average in there. We're not going to be looking at weightage. Okay, we're going to be looking at the simple moving average, which is the most common moving average out there, and the exponential moving average. Okay, so this is basically the calculation. When I look at it, I don't like, I know if I refer to my notes or whatever, I know what it means, but just one look, I wouldn't know, and that's totally fine. Again, more importantly is how you apply the indicator. More importantly, you don't know how your clothes are made, right? You don't know how electricity works, right? But you know how to turn on the switch, right? You know how to turn on the switch to use the electricity. So the same, this looks very complicated. More importantly, we need to know how this works, okay? So let's start with the simple moving average. The simple moving average is a straightforward technical indicator that is obtained by summing the recent data points in a given set and dividing the total by the number of the time period. So traders use the simple moving average indicator to generate signals on when to enter and exit a market. And SMA is backward looking, and it relies on the past price data for a given period. It can be computed for different types of prices. So for example, you can get it from the high, the low, the open, and the close, okay? In financial markets, analysts and investors use the SMA indicator to determine buy and sell signals for securities. The SMA helps to identify support and resistance price to obtain signals on where to enter or exit a trade. When generating the SMA, traders must first calculate this average by adding prices over a given period and dividing the total by the total number of periods. The information is then plotted on a graph. So the formula for simple moving average is written as, this was a calculation. Let me go back to the last slide. So yes, this is basically a calculation, okay? It's basically, let's say you choose 5, right? Let's say you choose your period as 5. So let's say the first price was 1, 2, 3, 4, and 5. Okay, you add 1, 2, 3, 4, and 5 together, you will get 15, okay, and then you take 15 and you divide it by 5, you will get 5. Okay, so that's basically how you calculate the moving average. It's just the average of the period that you chose. Okay, it's as simple. It's basically the name. It's just the average. And why is it called moving average? Because it's literally a moving average. Okay. So A is the average in periods and N is the number of periods. Okay, everyone good? Gonna move on to the exponential moving average. Okay, so the exponential moving average, which gives more weight to the most recent price points to make it more responsive to recent data points. So the exponential moving average is not as lagging compared to the moving average. Okay, an exponential moving average tends to be more responsive to recent price changes as compared to the simple moving average, which applies equal weight to all price changes in the given period. When calculating the exponential moving average, the following 3 steps are used. Let me show you the calculation again. This is the one, C minus P times 2 over N plus 1 plus P, okay? Okay, so yeah, 3 steps that I use are, number 1, you calculate the simple moving average for the period. The EMA needs to start somewhere. So the simple moving average is used as the previous period's EMA. It is obtained by taking the sum of the securities closing prices for the period in question and dividing the total number of periods. Okay? It's similar to the simple moving average, but you take the price from the close. Okay. Number 2, you calculate the multiplier for weighting the exponential moving average. So the formula for calculating the multiplier is as follows. Multiplier equals to 2 divided by the selected time period plus 1. So for example, if the time period is in question is 10, the multiplier will be calculated as 2 divided by 10 plus 1. Okay, so the 2 divided by x plus 1 is fixed. I'll just quickly go back. I know this is, so 2 divided by n plus 1. The n is the variable that changes, okay? And then you'll get your answer. So the last step is to calculate the current exponential moving average. The last step calculates the current EMA by taking the period from the initial EMA until the most recent time period using the price multiplier and the previous period's EMA value. It is computed using the following formula. The current EMA equals to, okay, that formula I showed you guys a while ago. Okay, it's basically the calculations. So what is the difference between the EMA and the simple moving average? Okay, the main difference between the 2 technical indicators is the sensitivity that they place on price changes. So the exponential moving average tends to show more sensitivity to recent price point changes. This makes the EMA more responsive to the latest price changes. The formula for calculating the EMA tends to be complicated, but most charting tools make it easy for traders to follow an EMA, okay? In contrast to the simple moving average, applies equal weighting to all observations in the data set. It is easy to calculate, being obtained by taking the arithmetic mean of prices during the time period in question. Okay, everyone okay with the definition? The definition of simple and exponential moving average? Don't worry. Don't worry, when I just learned it, I'm just like, oh, this is so dry. Don't worry, okay. I was there once before. For those who are new here, for those who already learned this, right? For those who already learned this, you're just like, okay, I already know this stuff, right? Then it's how we apply it. Okay, so I'm gonna teach you guys the natural moving average, which is what we use a lot here at Everest Fortune Group, okay? Oh, By the way, if you guys are wondering why I'm from FS Fortune Group, I probably forgot to mention in the introduction. It's because we have a special collaboration. Okay, we have a special collaboration to bring you guys these webinars so that you guys can grow as traders. For those who are already profitable, more information to learn, just a different point of view. For those who are still learning and growing as traders, I'm happy to help you guys be even better. Okay. So the natural moving average. When you go on Google, when you look for books on moving average, you always hear people saying, oh, the 100 moving average, the 200 moving average, the 50 moving average, the whatever moving average. My question is, can you guys, for those who use moving average, can you guys let me know what number or what settings for the moving average do you usually use? Is it the 50, the 100, the 200? I see Lola saying that she uses the 10, 60, and 200. Anyone else uses a different number? Okay, so Andrej, I hope I'm pronouncing your name correctly, uses the 50 and 100. We've got Kurt using the 50 and the 200 as well, only because that's what a video said to use. Okay, Kurt, I was using the 50 and 100 as well. It's called the golden cross and the moving average. Okay, right. I was using that as well because, yes, I saw a video that told me to use. Actually, no, it was from that course that I went, the one where I paid a few $1,000s to learn about moving average, right? That guy told me to use 200 and 100. I can't remember what it was. Okay, Philip uses the 15, Kingsley uses the 50, the 100 and 200, and Ola uses 7, 14, 89 and 200. Okay, very very uncommon numbers. Okay, so as the answers are coming in, I see a lot of people saying 50 and 200. Why? Because this is commonly believed to be the best settings to use. Okay, I'm not saying it's not good settings. It's just that here at FS Fortune Group, we have noticed that, I mean, think about it. Okay, think about it, right? Let's say you are going to a party, right? The theme of the party is Hollywood theme, right? You have this beautiful, I know I use dresses as a lot of my references, okay? You have a very beautiful, you have a very beautiful mini skirt, for example, and very tall stilettos, very tall heels. That short skirt is something you usually use when you go clubbing, right? When you go to the club, you use that very short skirt or whatever it is. But today the theme is Hollywood. Okay, the theme is Hollywood. So you expect really big, gorgeous ball gowns, fancy wavy hair, whatever it is. Okay, the dress will not, the outfit that you choose, which is a short skirt and maybe spaghetti strap, whatever it is, does not fit the theme of Hollywood theme. Okay, it does not fit the theme. So therefore, it's the same when it comes to trading. We don't believe that there is one number that fits all charts and all time frames. So we actually, when you're using the natural moving average, we actually adjust the setting to fit the chart rather than the chart fitting the setting. Do you know what I mean? Right? I understand 50 and 200 is a very common number when you're using the moving average. I personally was using the 50 and 100, but the 50 and 100 does not work on all charts and it does not work on all time frames and all pairs. So the 50 smoothen 10 LWMA low price. Is this okay, is that a setting that you use, Henry? Right, so we've got different answers. So which one do we use? We have found that the best settings to use when it comes to moving average is to use the moving average that fits to the charts. Okay, so let me try to grab my pen. I actually tried to use a pen. I can't really find the pen. Okay, draw. I think this is it. Okay. Here. Oops. Just give me a sec. Let me just clear all drawing. Okay. Can you guys see that this is what people usually use, right? People usually use the 50. When we look at the charts, the 50 looks like this, okay? The 50 looks like this, right? But you can see that there are times where price doesn't really touch the charts, okay? It doesn't really touch the charts, right? So a lot of times when we're using moving average, a lot of traders, okay, there's two very simple and known ways to use the moving average. One is when price breaks above the moving average, you enter for a buy, right? When it breaks below the moving average, you enter for a sell. Okay, that was one of the most common, the easiest thing the most common thing you hear about the moving average, right? Okay, the other way is to, when price comes back to that moving average, the moving average itself works as a form of support and resistance, okay? The moving average itself works as a form of support and resistance. So every time price comes here, the trader will look to get in for a buy here, look to get in for a buy. When it comes here, look to get in for a buy. It goes up, it comes back, look to get in for a buy, okay? So that is the other way to use the moving average. Give me a sec. Okay, that's the two ways. So dynamic and support resistance. Yes, correct. That's correct, said Henry. Okay, Karim is asking what's the best moving average to trade on, the 15 minutes or the 1 hour? Okay, when it comes to moving average or any kind of technical analysis, again, I need to remind you guys that the best moving average that you should be using is the one that fits perfectly onto the the one that fits well on the chart and is effective on the chart. So I would say the moving average is effective on both the 15 minutes and the 1 hour, depending on the settings. Okay, it depends on the settings, right? It can work on all charts depending on the settings. Okay, so let me just erase everything. Let me just erase everything. Sorry, I need to just give me a sec. Okay. Okay, so this is the 50 and this is the 46, right? Can you guys tell me, if you were to get in for the bounce, which charts would you prefer using? Just give me a while, Karim, I'll answer your question in a while. If you were using the strategy, right? If you were using the strategy where you wait for price to come back and you get in for a buy here. Every time price comes back and you get in for a buy here, which charts would you trust more, A or B? Would you trust chart A or chart B more? Okay, yeah, definitely the 46. But 46 is not a common number used for moving average, right? It's just a random number that we chose. Okay, I see someone saying B. Okay, actually why we choose A is because, remember saying the moving average works as a support and resistance, right? So every time price comes back to that support, you expect to get in here for that buy. But can you see here? This is the exact same charts, okay? It is the exact same charts. It's just that the settings was tweaked. The settings for both moving average was changed a little. This one, whoops, let me go back. This one is the 50 and this one is the 46, okay? We manually went into the settings and changed it to the 46. Okay, we manually went to the settings and changed it to 46, and we can all agree that the A looks better when we're looking for entries. Okay, A looks better when we're looking for entries. Why? This is the exact same chart. If we were to use this chart, if we were to use B to get in for a buy, right? Think about it. If we were to use B to get in for the charts, B didn't even touch the moving average and we would have missed this buy entry here. Whereas here on the A charts, okay, whereas here on the A charts, price nicely touched the moving average and you enter here for the buy. Okay, so this chart is more accurate, we can safely conclude that the A chart is more accurate compared to the B chart. So whenever we are using technical analysis, to make our decision making, we need to take note, okay? We need to take note that our only job as traders or analysts is to try our best to find the most accurate information, okay? To try our best to find the most accurate as possible information. And there's no black and white written anyway to say that, oh, you must use it this way, you must use it this way. The best way to use something is whatever way that you find is effective, okay? So we have found that this is the most effective way to use it, okay? Okay, let's, let me just remove all the drawings, sorry. Okay, bonus, combining moving average with other strategies. Sorry, this is not the one we're supposed to identify reversals with the natural moving average, and that is exactly the strategy that that is commonly used, which is to buy, get in for the buy. Whenever price comes to the moving average area, you get in for a buy. Whenever price gets into the moving average area, you get in for a buy, the support and resistance. Okay, so looks like we still have about 20 minutes. We can do the bonus, which is combining moving average with other strategies. Okay, so let's move on to the live charts, right? Let's move on to the live charts so that we can apply what we learned today, okay? Give me a sec, let me exit, let me share a new screen. Okay, can I check if everyone can see my charts? Okay, cool. Everyone can see my charts, right? Since we're doing a practice, we might as well try to find a setup. Can you guys, if you guys have any requests for any particular pair or instrument, do let me know in the chat box, right? If not, I'm just gonna randomly choose one. Okay, I'm just gonna randomly choose one. Let's do maybe sugar. Okay, that's a really, any forex pairs? Sugar is a very uncommon, okay, I think sugar is a future, it's usually a future chart, right? Okay, let's see how well, maybe let's do GBP NZD instead. Okay, let's do GBP NZD instead. Let's try to do a forex pair, because one thing about the sugar chart, we can do it, but because it depends on the chart you use as well, right? This chart particular, I wouldn't want to use this because there's a lot of gapping. It's probably because it is not a 24 hours chart. This chart is closed. Okay, let's try to do GBP NZD. I see a request on BTC USD. Would love to do that. I am a crypto trader myself. Okay. Okay. One thing about the moving average that you guys might want to know is that the moving average works very well on trending markets. Okay, it works very well on trending markets. You can see here that market is kind of going sideways. There's a little bit of a triangle going on, right? There's a little bit of triangle going on, but it works better when it is ranging. Okay, it works better when it's ranging. Okay, so there's two strategies that I will be showing you guys. The first one is to use correlation. Okay, look at the charts that we chose. We chose GBP NZD. Okay, we chose GBP NZD as the chart. So can you guys let me know in the chat box, do you know what pair is closely related to GBP NZD? what forex pair is closely related to GBP NZD. There is correlations with pair. It's the same with USD, the Canadian dollar, and oil. Why? Because Canada is a very big oil producing country, right? So the GBP is very closely related to, yes, thank you so much, Kurt. Yes, the GBP NZD is very closely to, number one, the GBP AUD, because the AUD and the NZD is very correlated. Okay, for those who are not sure, you can just go currency correlation strength. Okay, just go to my FX book. My FX book is a good one. Okay, this is where you find correlation. Okay, let's say you're looking for the GBP EUR, actually the GBP NZD, okay? The GBP NZD, when we compare it to the EUR NZD, you can see that there is 89.6% correlation. It's very, very correlated, okay? Because the GBP is very related to the EUR and the AUD is very related to the NZD. Okay, so one way we can use the moving average strategy is to use correlation, but then again, you can use correlation with a lot of things. How you do that, you see this plus button, right? You can plus, click on that, add the correlating pair, which is the GBP AUD. Okay, we're gonna add that in. This is not the one that I wanted. GBP AUD. Sorry, just give me a second. I'm trying to add in another chart. Okay, so you put it as new panel, new. Okay, and it will show below it, right? It will show below it. Just go into settings and change that into, just change that to, I want to change this to a candlesticks pattern chart. Okay, these settings are tricky, it doesn't matter. You can see the price action going on here. Okay, now we're going to pull out the moving average. We're going to pull out a moving average. Why? Because this is our topic for today. So we'll be focusing on the moving average. Okay, on this, we'll be pulling out the moving average as well. Why isn't this coming off? Okay, guys, I think it's much better if I just open another screen. It'll be much faster if I just open another screen. Usually I can compare both charts. It's just somewhere in the settings that I don't see today. Okay, so one of it is GBP NZD and the other one is GBP AUD, right? Okay, we're gonna go into charts. I'm gonna get rid of this since it's not helping. And we're gonna see how correlated this pair is to each other. Okay, we're gonna see how correlated this pair is to each other. The more correlated it is, the more we want to use it. Okay. I'm gonna get rid of this. Okay, again, this chart was not the best to chart on anyways. Okay, we want to see what is happening on both charts. We want to see what's happening on both charts. So this is the GBP AUD and this is the GBP NZD. You can see that from here, price broke kind of like the moving average to the downside. So naturally, you want to enter for a sell, right? Just using the moving average, you want to enter for a sell. But you can see from the past, every time it broke the downside, it was a fake out. It comes back and fakes out. It comes back and fakes out. So what can we safely conclude? It breaks here, it goes up, didn't really give you a good move, and it came back down, broke it. Okay, you would have been able to caught very small moves. What does this tell me when I'm looking at it? It tells me that the moving average doesn't work very well on GBP AUD on the 1 hour time frame. Okay, let's look at how it works on the GBP NZD. By right, price is supposed to break, go back. Every time it comes here, it's supposed to bounce off. It doesn't bounce off. It keeps breaking and keeps doing fake outs. It keeps doing fake outs, keep doing fake out. It means this is not an effective, moving average is not an effective indicator on the 1 hour on the GBP NZD and the GBP AUD at this current point of time. Okay, maybe in the future it'll work well, but at this current point of time, today, okay, today it does not work well. Okay, so let's quickly go and look at another pair, USD AUD maybe. Okay, and the USD NZD. Okay, I just want to quickly show you guys an example of correlation. Okay, the first thing I'm going to do is change this to the moving average, natural moving average. So how do you look for the natural moving average? What is the settings? I think someone was asking me earlier on, Karim was asking me, what is the setting? So we don't have a specific setting because again, we are adapting to the charts, right? We don't have a fixed setting, right? It's not 50, it's not 100, it's not 75, it's not 200. It is not a fixed setting. So the settings that we go for is usually using Fibonacci levels number. So the Fibonacci level, that is the 28, okay, the 28.6, the 32, the 50%, the 61.8%, and the 78.6%. Okay, so these are some of the Fibonacci numbers. We try to use this number and we see how well it works. Okay, so let's say we move it to the 28%. Let's see how well it moves. Okay, do you guys think this is a good number to stick on? Okay, price came here, it broke out, did a fake out, came here. By right, when it comes here, it's supposed to bounce. Comes here, it's supposed to bounce. Okay, no, I don't think this is very good settings. So we need to adjust the settings again. We need to adjust the settings until we find a good setting that works well on our charts. So let's try the 32. 32 is not a good one. 50. Okay, I think 50 will not work. Let's try 61. Nope, doesn't work very nicely. You want to find a setting where price was respecting for a while, and that is the settings you're going to be using. Okay, let's try maybe 70. Okay, I think 70 is not the best. Okay, again, I'm just randomly choosing number because I'm trying to find a number that fits well. The thing about natural moving average, because there's no fixed number that you should be using, you kind of just need to experiment and tweak the settings yourself. Okay, why do I think 70 is a good settings for AUD at USD AUD at this current point of time? Because why? Okay, you can see price broke here, it came here, it reversed. It came here, it reversed. It came back to the resistance, it reversed. Okay, so just using these settings alone, we can safely say that price respected these settings. Okay, only on the first time it finally broke. Okay, it broke, it broke, it broke. It came here. Maybe the settings can be tweaked a little to make the moving average go under. Okay, but that will take a bit of time. We don't have a lot of time left. So let's say I've tweaked the settings to a better number and price was nicely respecting this moving average. Okay, maybe the correct settings would be like 72 or 75, whatever it is. Okay, it comes and reverse here. It breaks this, comes, respected this, turn back, broke, came here, respected this area, bounce, broke, respected this area, bounce, and then it stopped respecting. Okay, so my whole point of showing you this is that you need, when it comes to natural moving average, you need to find the setting that fits well to your charts. Yes, it will take a bit of time to find the correct settings, but you can just randomly jump and hopefully land on one that works. You can start with 10, 20, 30, 40, 50, 60, 70, 80, and see which one works well. So let me try 80 to see. See, the more I adjust, the more nicely it moves naturally. Okay, the more nicely you can see that price came here, reversed nicely. This part doesn't respect so nicely anymore, reversed, reversed, and here it breaks. Okay, so if this continues, if this moving average, this natural moving average is still working good, we expect price to do this, come back and retest nicely here, and then we can get in for a sell. Okay. So the other way, how we use correlation, right? The other way, maybe I can try 88 because that is a Fibonacci level. At 88 doesn't work well. Okay, maybe it's a 70. 70 was probably the, or 80 was probably the best as of now. Okay, now we go to NZD USD. You pull out the exact same settings, which is the 80, and see if that works well. Okay, let's get rid of everything else. Trying to show you, okay, here price respected the 80. This part didn't respect, this part it respected, this part respected, it respected, didn't respect here, didn't respect here. Now it's not respecting. It just means 80 is not the correct settings for NZD, USD, NZD. Okay, that means we need to tweak it again until we find a better one. Okay, 100 is not the settings as well, maybe 120. Okay, 120 looks like a little bit better settings, right? It looks like a little bit better settings. We need to find the best settings for the charts. Why? Because we are using this to get our entry, right? You know what I mean? We are using this to get our entry. And how I'm using correlation. Okay, we only have 5 more minutes left, so I don't really have time to slowly look for the perfect moving average settings. Okay, it does take some time. Okay, let's say the moving average, I'm just gonna draw a fake moving average. Okay, let's say you found the perfect settings, okay, and it's respecting price. Okay, so why I use correlation whenever, okay, let's say I found the settings and this is the moving average that I think fits best. Why? Because price came here, bounce, came here, reverse, came here, bounce, came here, bounce, came here, bounce, came here, bounce. So when price comes to my moving average again, I expect it to bounce again. Okay, so why am I using correlation? Because if I expect price to bounce, it means that I expect price to be a buy, right? My bias right now is a buy. Okay, the bias right now is a buy. Okay, so now what I do is I go back to my correlated pair, which is the AUSD, AUD. Oh, by the way, the thing that we usually use is actually the AUD, USD, and NZD USD, but I already typed it, so it doesn't matter. Okay, let's say we have found a very nice moving average to use as well. Okay, and it looks something like this. It looks something like this, for example. Okay. Something like that. So when we're looking at the USD AUD, we are also biased that price is going to come here and bounce. Similarly to USD and NZD. So you're using the correlation on both the charts because again, when you go to the correlation, you can see that they are, for example, 80+% correlated. They're 87.1% correlated. So the USD AUD and the USD NZD is a very correlated pair. So if your bias for one pair is a buy, the other pair should also be a buy. Okay, do you get what I mean? So that's how you combine correlation with moving average or any other indicator to confirm your bias. Okay, because you know, when I am trading, I think I have won half the battle once I have established the first question. So the first question I always have to ask myself, and I hope I get it right, is price moving in a downtrend or uptrend? Am I getting in for a buy or a sell? Okay, if you got the direction correct, I really think you would have won half the battle already. Imagine you think it's a sell, but actually it's a buy. It's a very, very long buy. So using correlation and moving averages, you are able to confirm, the direction that you want to get in on. Are you getting in on a buy or are you getting in on a sell? Okay, that's one. The second strategy that I'm going to show you guys. So the first one is correlation. The second strategy I am going to show you guys is the usual strategy that I use on a daily basis. One is to combine, right? Combine the moving average with support resistance, Fibonacci levels, the moving average, other indicators, and chart patterns. Okay, so the first thing I'm going to do is look for trend direction. I do see price moving on an uptrend. If anyone else sees anything else, do let me know. I only see price moving on an uptrend. In fact, it is moving in an ascending channel. Okay, it is moving in an ascending channel. Okay, now I am going to highlight some support and resistance. Okay, there is support and resistance here, right? There's support and resistance here. Okay, so right now looking at a channel, I am biased that price is going up. Okay, I'm biased that price is going to go up. Why? Because there is bullish momentum. Two, I think price is going to go up here. Why? Because there is a horizontal pullback level here. Okay, three, why do I think price is going to go up from there? Because when I pulled out the Fibonacci, right, there was the 61.8 lining up on my support, okay, which is giving strength to my support. Okay, that's three, why I think price is going to go up from here. Four, why I think price is going to go up is because when I pulled out the moving average indicator and I used the natural moving average and I adjusted the settings, okay, guys, again, we don't have time to find the exact settings for these charts. That is just, you have to toggle with it, right? When I pulled the moving average indicator, there was a moving average here. So I expect price to move down here and bounce here. So the other strategy that I'm trying to show you guys is to combine the moving average with other technical indicators to get an even more accurate analysis. It's the same concept as the pink dress that you wanted to buy. You want to buy a pink dress, you don't know if it's good or not. So you ask your mom. Okay, your mom says yes, your dad says yes, it looks good on you. You ask your grandmother, everyone says it looks good on you. There's only one guy who says it doesn't look, it's your brother. Your brother says it doesn't look good on you. But you're thinking, so many people told me it looks good. I don't care what my brother thinks. I'm gonna get the dress anyways, okay? So right now we've got so many things telling us that this is a buy, right? You are going to get into this buy because there's enough reason to believe that price is going to bounce from here. Okay, so you use moving average with everything else, combining with everything else to get an even more accurate analysis. Okay, one thing you need to remember, you need to drill it very hard into your brain, deep into your brain, is that your only job as a trader is to find the probability of whether a trade will work or not. Okay, you want to get in here for a sell. You are now going to use technical analysis, fundamental analysis, whatever it is analysis you have, maybe your gut feeling, maybe whatever it is, whatever you can use to find how probable is price going to come here and reverse from here. Okay, using technical analysis, you will be able to narrow down or give yourself a rough percentage of whether a price is going to work. Because let's say you have established that an analysis is, oh, there's an 80% chance that this is going to be a buy. That means you get in, right? But you see, it's totally different. I think a lot of laymen have a conception that trading is gambling. It is not gambling. It is calculated, collected data and risk management. Okay, the difference with gambling and trading is based on very high probability. Okay, whereas gambling, for instance, you go into the casino, you play blackjack, it's a 50-50. It is a 50-50. Okay, you play roulette, it is a 48% chance of winning. Playing blackjack is a 50% chance of winning. Playing the slot machines is a, I don't know how many percent, maybe 3% chance of winning. Playing, I don't know what other games there is in the casino. I can't even think anything, okay? The probability is against you. Why? Because the probability is so low, chances of you losing to the casino is higher. The casino always has the upper hand to win you. But when it comes to trading and the charts, you get to use technical analysis and all these tools to narrow down how probable a trade is. If it's probable, get in for a trade. If it's not probable, don't get in for a trade. Save the money and don't get in for a trade, okay? So that's all. Yes, I would agree. I really love poker. I think poker is a game of skills, right? I would agree. Trading is kind of like poker, right? I would have to say poker also has a lot of luck involved in it, right? But trading is maybe a lot more skills and research. Okay, so that's all I have for you guys today. I will catch you guys again. Thank you so much. I'm glad you enjoyed this class. I'll catch you guys again next week. Thanks for attending. Take care, everyone. Hope you learned something. Yes, more importantly, hope you learned something. That's the most important thing here. Hope you guys eventually will be able to grow your accounts into millions and millions. Okay, so I'll catch you guys again. Bye, guys. Thank you so much. Are you or Desmond taking the trading tomorrow? It should be Desmond. It should be Desmond. Tomorrow is live trading analysis, right? Tomorrow is the live charts, right? It should be Desmond, right? Because I will have another webinar to take, right? But if you guys wanted me to take it, you guys can just write in to IronFX and tell them, just write in, maybe drop an email so that you prefer me, or it doesn't matter because me and Des, we can swap any day. It doesn't matter, it's just what you guys prefer. Because ultimately, again, we are doing these webinars for you guys so that you guys can learn better. Okay, so thanks guys. I will see you guys again soon. Okay, bye. Let me turn this off. I need to figure out how to turn this off.
A central bank is a financial institution that is responsible for the distribution and control of funds and credit regarding a nation or a group of nations. In fact, central banks conduct monetary policy. They do so by changing interest rates or adjusting money supply through open market operations. Having a monopoly over the distribution of money essentially means that central banks cannot run out of money. Actually, any amount of money required can be issued by central banks to satisfy their needs. This also means that they cannot run out of liquidity. People also refer to central bank as reserve banks, monetary authorities, or Federal Reserve. The first central bank to be established was the Swedish Riksbank in 1668, while the Bank of England, which was established in 1694, set the motto based on which the majority of central banks operate today. Another major objective of the central bank is to manage a country's currency. Generally, the central bank imposes the uses of national currency within the underlying jurisdiction. This way, all commercial banks should accept the currency when people present it. Taking the Eurozone as an example, all commercial banks within Europe should accept any euros provided by their clients. The same goes of all citizens of the state. They should be able to receive the specific currency for any work or services they provide. Stay tuned for more terms.
Hello everyone, my name is Emily and today we will look at candlesticks. You may have seen candlesticks on a chart, but if you don't know how to use them yet, here is some useful information to help you get started. In financial technical analysis, a candlestick pattern is the price movement shown graphically on a candlestick chart for a specific period of time. Candlestick charts are used by traders to predict the future price movement based on past patterns. The recognition of the pattern is subjective, and there are programs for charting based on predefined rules to match the pattern. There are 42 recognized patterns. Some of them are simple and others more complex patterns. Something that most people don't know is how old candlestick charts are. They originated in Japan in the 1700s when a Japanese man named Homa discovered that. Despite the connection between the price of rice and its supply and demand, the markets were more influenced by the emotions of traders. Trading is often influenced by emotion, which can be read in candlestick charts. Candlesticks show this emotion in color. The different price movements are shown in different colors. Traders use the candlesticks to help them decide whether to trade by analyzing repeated patterns that can help determine the short-term direction of an instrument's price. Candlesticks are ideal for short-term traders as they can help them decide when to enter or exit a trade. Candlesticks are basically formed by the opening, high, low, and closing prices of a financial instrument. The main body of the candlestick is called the real body. The real body represents the price range between the open and close of that trading day. If the opening price is above the closing price, then the candlestick that is formed is filled and is usually red or black. If the closing price is higher than the opening price, the real body of the candlestick will be green or empty. In other words, the candlestick will appear white with a black outline. Traders can change the colors in their trading platform. For example, a down candle is often red instead of black, and up candles are often green instead of white. The lines above and below are known as shadows, tails, or wicks and represent the high and low price ranges within specified time period. However, not all candlesticks have shadows. In the next video, we will look at candlestick patterns in more detail. Stay tuned. Thank you so much for watching. Bye-bye.